Good day, investors. Today we are looking at another Norwegian oil company. This time this is not state-owned. This is AKRBP. It's a pure oil and gas producer, mostly oil, and every asset they have is in Norway. They have huge advantage in costs. They are really, really cheap producers. They are technically really strong, as you will see in detail, and I would say they're fairly valued with some growth coming up in 2027, and they are expecting to maintain and increase production. We'll see about that later. On the meaning side, you can see on the next slide, I will see next two slides, you'll see their breakdown or where their profit is coming from, but they are mainly oil with some gas. They are extremely cheap producers, which is amazing. They have a disciplined approach to capital allocation, both to brown and green fields, so they develop but also join other projects. They aim to have a nice dividend growth of 5% if North Sea oil stays above 40 a barrel. And they have some new major project coming up, as we will see, boosting and maintaining production. So what is AKRBP? Aker is coming from the biggest shareholder, Aker Capital, which is, as you can see in the description here, investment arm of Aker ASA, a Norwegian industrial holding company, long-term strategic owner, and which is great. And then you have BP Exploration Company, which is second largest shareholder. It's a subsidiary of BP itself. So that's where you got the name of AKRBP. Of course, you have Nemesia, which is basically the Lundin family, an investment company owned by the Lundin family. What is Lundin family? They used to own Lundin Energy, right? And following the merger of 2022, they retained their stake in the merged company. More on that later. And then you have a manager of Norwegian government pension fund, which is domestic. So you have a pretty good lineup of interests with this company. So I would give that a huge thumbs up. You have skin in the game, you have expertise, and companies want it to succeed. So it's not mainly owned by institutions and pension funds, which probably would just want to see steady cash flows and put all their demands, ESG and environmental expectations of the company. This is not the case with this company. You can see that most of their assets, actually, I believe all of their assets are within Norway, which is great because Norway is a stable country. It's from a jurisdiction perspective, it's great. Of course, they have really high taxes on oil, 78%, but we'll talk about that on the margin of safety side. So you have a good location to hold assets which are really long term. And on a segment breakdown, volume sold, but what we really want to see is total income. And you can see it's dominated by liquid, so it's dominated by oil, and then you have some natural gas. Pure play, you don't have ESG, you don't have much electricity, no nothing. You just have oil and gas, which is I really like because they're focusing on their strength. So Norway, NCS is the shelf, is the Norway area. Jurisdiction is really good. You have a strong infrastructure. You are lowest cost producer. So on this chart, you will see Equinor here as the cheapest, but you would see Aker basically the same, maybe a bit lower. As they compare themselves on their annual presentation, keep in mind that companies tend to make themselves look better, but this time AKRBP is actually really low cost producers. Why that matter is that basically this is a market where the prices are set. Everybody are price followers, so the one who has the lowest cost wins. Although everybody wins, but lowest cost wins most, right? If you look at this, prices go down, Suncor has to stop production, Exxon some wells, so not all of that, right? Because these companies have higher and lower cost wells, but they have to stop production. They don't have to. 1, 2, they are less volatile, right? I mentioned it multiple times, but let's say you have a break even at $100 a barrel. If oil prices at 101, you make $1 profit. If oil prices go up to 102, you make $2 profit. That's 100% increase on your on your profits. If your break even is 50, first scenario you make 51, second 52, you only have $1 more, so that's really volatile increase in your earnings, like 4% or something. So that's also why these companies are more less volatile, so more predictable cash flows, given predictability relative, given because we are talking about global oil prices and anything can happen. Synergies from the Lundin merger, right? So it first geographic focus, right? So Norwegian continental shelf, politically stable, highly regulated and efficient operating environment. So one, they have huge industry leading low lifting costs around, they say $7-8 per share per barrel of oil. Of course, they have an infrastructure advantage, right? So post-Lundin mergers, they have scale, which created synergy across major hubs like Alvheim, Skarv, Valhalla, and so on. They have strong ownership structure, so right, because they are backed by BP and Aker. So Aker owns 21%ish and BP 16%, which ensures technological collaboration and financial discipline. And then, of course, the fast tieback development advantage. So efficient tieback model that enables a quick payback times and reduction in risk. So these all great moats for the company. If I would have to pick two, I would pick low cost and the jurisdiction they are in, and that they are really focused on really cheap wells. Right. So management. Carl Johnny Hensik, CEO. Yeah. So since 2014, technically really strong, and they have a track record of cost discipline and projects execution, which is great. Management emphasizes efficiency, uptime, disciplined investment, maintaining strong operational cash flows across cycles, right? So, and this is not as common as you might think. If you think about Petrobras in the 2010s, they wasted a lot of capital on corrupt, unprofitable projects, right? Which sort of ended with this Carver scandal in 2014 and the following. So it's not like cookie cutter, I could say, to every company. They have a proven ability to integrate acquisitions like the Lundin Energy merger and deliver synergies. The CFO, I think David Tonne, and the board focuses on predictable shareholder return and conservative leverage. So you can basically see it here that they want to do 5% increase per year if the oil prices stay above 40. Financial priorities, of course, flexibility and investment grade rating. We'll see it on the margin of safety side when we look at the balance sheet key numbers. Of course, this is a commodity company, even though they are really low cost producers, so they shouldn't really ever have an issue. They are commodity producers, so they want to have really good balance sheets in place if they have to borrow. Capital allocation focuses, of course, financial capacity, as I just said, profitable growth, which is of course going to happen because it's really efficient to work there. Return value through dividends, so you will see they are not really big on buybacks, and they want to pay quarterly. Yeah, prudent capital. Yeah, so some of these are sort of repetitive if you think about it. So these are some KPIs managements are paid by. Of course, you want to have safety, net production from operated assets, right? So you don't want to have them idle. Adjusted production cost, really important as a price follower business. Net reserve additions, so you don't want to run out of oil. So for example, you remember, or if you haven't seen the BP video, BP is really struggling with their own reserves. Aker is doing fine. Yeah, so Aker is doing fine with their reserves. They have around 10 years, so I don't have it on the slide, but I have it on my numbers Excel. So if I calculate manually their reserves / production outlook, they have around 10 years worth of reserves. That's on average what usually these companies have. BP has like 4 or less. So just to put you in perspective, and maybe Petrobras has 12, 13. So they are fine. Valuation, right? Relative shareholder return. Yeah, so this ties in with their total shareholder return policy and equity share. Yeah, some green stuff, but you will see that, especially in European companies. Management, how is their debt and remuneration history? So you can see the share price in blue it usually goes with Brent crude, right? We saw a couple slides before on the segment breakdown that they are mostly making selling oil. Most of their money is coming from oil, a bit less from natural gas. Basically, it's a proxy for the Brent crude, their share price, and you don't see much buybacks, which I sort of like. I really appreciate, right? Because what commodity companies tend to do when they have, look here, look here, look here, when oil prices is high, they're gonna have a lot of cash, as you can see in green free cash flow, and then they're gonna do a lot of buybacks when their share price is already high because it tracks the commodity price. And then they buy back shares at high prices, and then share prices go down. They don't have cash because the underlying commodity goes down in price, and then they don't have cash to buy back on the cheap. What they do at Aker, they just pay you dividends, they pay down debt. So you can see debt go down drastically, right? And then you can see dividends going up with the cash flows from good years. What I want to highlight here is that from 2018 to 2024, their outstanding shares actually grew 75%, which is due to the merger deal. So they had a deal to 2.2 billion cash plus new shares. So, and they issued new shares, acquired Lundin Energy. That's why you saw that. In the end, it helped their operations to be better, and then they deleveraged also on the way with good energy prices. So field developments driving growth and value. So they are trying to make new assets come online, which is great. We will see how their execution looks like. So they are spending a lot on capex to bring these online, but it's I would say it's a risk. So watch out for delays. They say startup in 27. Maybe in the share price it's already discounted, probably, right? In the share price that you're gonna have these production facilities come up. Well, if they delay it by a year, you will see probably an influencer. So let's say on the next annual report, they're gonna say, okay, actually, well, we come up at 2028. Then you will see a drop in the share price because cash flows are not gonna come in for a year. So keep in mind for that. But these are all relatively cheap, right? So the best estimates at barrel. So they want to have a really nice and really cheap cost production wells. On the margin of safety side, we can look at their 25 guidance. They increased actually guidance from how much million barrels of oil they're going to produce. I'm using this for, and also using this, and all of this I use for my own projections. If looking at it, 2025 should be 4. So you have a 15. So the 417.5 million barrels of oil sort of production should be this production cost. I use my own calculations, but it's really close. Capex should be around 6.5 billion. So that's actually a huge amount of capex for a company of their size. So we'll see it on the numbers. Okay, exploration and abandonment, right? So this is what production will look like for them. I use this chart to make my projection estimates. Hopefully they're gonna stick to this, right? Especially gold companies usually project huge growth and then nothing materializes. Let's hope Aker is not doing that. Historically, they've been relatively good following their own projections, so that's great. And then, of course, investing in high return projects. So total capex, I'm also looking at when I'm putting together the projections. And margin of valuation. So capex break even, which I calculate manually. Of course, this is pre-tax break even because they have a 78% tax rate in Norway and oil and gas, although the effective rate is a bit lower if you use free cash flow. Oil prices are used for every company I analyze. So capex using projections, break even using calculated. And what comes out is that, of course, in the guidance, they say 6.5 billion, and then they say they're gonna wind down a bit of the capex. Using, of course, I try to make it as valid on the effective tax rate side as possible. So I try to use higher tax rate when oil prices are higher and lower tax rate when oil prices are lower, using historical data. So you want to kind of get to like, these are like, this is not like, I estimate the value to be around $14.64 per share if you have a required rate of return at 10%, and you get all the production on average what they are projecting. Of course, there can be changes. If oil prices go up, valuation goes higher. Oil prices down, valuation lower. If they spend more or less of capex, valuation up, down. Cost can change it, right? So you have all of these factors. Overall, the company is really profitable, I would say. They would be extremely profitable, but of course you have taxes, right? So half of that goes to the government. That's why you have return investment lower. That's why you have return equity a bit lower. I only used from 2022 to 24 due to the Lundin merger. That's when the company kind of became what it is as it is now. Their debt to equity is manageable, and of course their coverage ratio is easy because you can pay interest before you pay the taxman. So you have huge amounts of money coming in. You can pay your interest payment, and then you pay less to the taxman. Their cost of debt is really low, and their debt to, so balance sheet fine, easily manageable. What I see, and of course you have a forward yield according to Yahoo, close to 10%, right? What I'm afraid of with this is that, is this capex really coming down? So if I jump back the next slide, okay, so this is going to be our production, this is going to be our capex. How does that look like? So how oil gonna look like in the years after? Because this is relatively high capex for a company of this size. So maybe a bit too much, but they know better than I do. They are running the business. So you have the oil price volatility. They don't really have these balancing acts. So they have not that much gas. Like Equinor has huge amounts of gas. Some other companies have electricity and other areas. They have their own issues. Usually those are lower return product, but you are more volatile due to this. So project delays and cost inflation. So if you expect to spend 6.5 billion, you spend 7. Here you expect 5,750. You spend 6. So those can change the picture. And then I would say single region exposure for Norway. I listed it as a risk because they are not diversified, but I also listed it as a strength on the Moat side. I would put it more to the strength bucket, but I would just like to mention that, hey, this is only Norway. If Norway goes crazy, right, what are the odds that they do? They already have really high taxes, and they just how would you say it, like paused their ethical investment principle for their $2 trillion fund, reasoning that they don't want to divest tech companies until late 2026. So Norway is going away maybe from ESG, and then they can refocus on oil. So that's overall, Norway is a really good place to do business as an oil company. You have really efficient wells. You have high taxes, right? Tax rate is effective rate a bit lower, but that's it. I think a capex could be a bit too high. That's my fear, and of course everything depends on oil prices, although they are low cost. As a summary, pure play oil and gas, especially oil, focused on the Norwegian shell, low cost, disciplined capital, if capex gonna be reasonable. So far they've been disciplined. They are fine, dividends are tied, everything tied to $40 oil prices. I would say that there was an August 2025 report that US shale break even is basically $65 VTI, not even Brent crude. So if oil would go down to 40, I think like 60-70% of global oil production would be at or below break even. At 60, they're like half of them are at or below break even. So it would balance supply demand. So it's moderately predictable because of oil price volatility, although they are low cost. Cost leadership, right? They have operational scale. They are backed by AKRBP expertise, right? They had a good merger with Lundin, and then Lundin is also the family stays as a shareholder, so they have skin in the game. Shareholders, very strong leadership, cost infrastructure, moat, and great jurisdiction with Norway. Track record, of course, yeah, they've been fine. I'm just, so maybe my risk averse attitude towards their future capex is over hyped, because so far they've been doing great. So all what they've been doing paid off. They were on time, executed while paying consistent dividends. So that shouldn't be an issue. So solid, disciplined, consistent capital allocation. So management's great, and margin of safety side. So this is where I come down. So how much the business is worth. So you can overpay for a great business, and that great business becomes a affordable investment for you. I think it's around fair value. If your hurdle rate is around 10%, you have upside risk if oil prices go higher. So if you pay, let me see, you have AKRBP here. So I think the company is worth 14.5. Now it's trading at 13. So technically you have an 11% upside. Well, and they have nice numbers here. So this uses 7-year average on the margin of safety. I only used the last since 2022. They are fine. Although if I annualize their Q3 free cash flow yield, it's only 4%. So that's my thought. Like maybe they overspent capex already for the year, and then the Q4 gonna bring in more free cash flow and help this number out. A lot depends on oil prices, and they are growing and they are putting in capex. If you look at Shell, or you look at the US shale producers, basically any energy CEO, you look at the OPEC comments, everybody expects oil to be in a glut in early 2026. And then maybe you could look at my total analysis where I have a timeline where they say how well growth and demand growth will balance. So everybody expects Q1 26 to be in a glut, Q2, Q3 still in glut, and then it becomes even or even a deficit. So many things depends on oil prices. If 26 is a glut year, if it is, everybody long term everybody expects it to be fine, then their investments would be a really smart one because they're come online in 27 according to schedule. So we'll see. They have growth. They have probably a good oil price outlook, but nobody knows oil prices where they would be. You can only think in bets, so you can think about the odds oil goes down low more or goes up more. I would say around today's prices, which are like 60 VTI and 63 for Brent, you have half of the global production at or below break even. So how much more than it could grow? That's my take, and that's my bet. And of course, this is, you can pause the video here. These are the commodity price assumptions I use in the model, updated recently. Of course, oil goes up, oil stocks will go up, their cash flow will go up. Many things will happen. If gold goes here, are there, silver goes up, silver mine producer. So this is the game commodity prices, price producers do. How you identify good commodity price producers is based on their cost base, and you want to buy them cheap and hold on to them for life, or sell them at the boom. If you enjoyed this video, please like and subscribe. Let me know of any stocks you might want to look at. This AKRBP was suggested to me in the comments. Luckily, I already had it semi-ready, so I just had to do some research more. So I do read, I do make videos based on requested comments. So thank you guys. Take care, and have a nice day. Bye.